Okay, guys, welcome back. Confirm you can hear me and see my screen. Hello, team. Confirm you can hear me.
Yes.
Okay, can you see my screen?
Yes.
Okay, so let's continue. So we said a share is a representation of how much you would have invested in a business. So if a business has got a share capital of 100,000, shares of $1 each, it means the total amount invested will be 100,000. If you've got 20,000 shares, it means you would have invested $20,000 in terms of your share capital. Now, there are broadly two types or classes of shares. We've got what we call ordinary shares and what we call preference shares. So the ordinary shares are the shares that we have been talking about. Is the amount of money that the owners of the business would have invested converted into the number of shares, such that if you say the number of shares times the par value, you get the total amount invested. So the people that hold ordinary shares are actually the people that own the business. Now, a company may want to, say, raise money. They go to the owners of the business and ask for the money, and perhaps the owners of the business do not have adequate money to actually finance what the business want to do. So as an alternative, the company can then approach usually an institutional investor or companies that invest in other companies, like, for example, your NASA, your Old Mutual, etc., and say, we want to offer you shares in our company where we are going to be paying you dividends, but we don't want you to become part of the owners of the business. So you are not going to be involved in the decision making, but we are then going to be paying you a fixed amount of money every right? So these are called preference shares. So the holders of preference shares are not actually owners of the business. They are more or less like providers of finance, but what they would have invested is converted into shares that entitle them to a certain amount of money every year. Okay. So in terms of voting, we say the decisions in a business from a shareholder's perspective is made through voting, so that the more people vote for a decision, the more likely it is to be made. Ordinary shareholders have voting rights. So they have full voting rights. They are the decision makers in the business. But preference shareholders do not have any voting rights, which means they are not involved in the decision making of the business. So they have no voting rights. There are certain instances where preference shareholders may have voting rights, but it's out of scope as far as our syllabus is concerned. So as far as we are concerned, preference shareholders do not have voting rights. Then we said that can you please mute your masks, your mics, so that we don't get feedback from your background? Then in terms of dividends, we said if a business makes money and it wants to then share the profits that it would have made with the owners of the business, it does that through paying dividends. So dividends are basically a share of the profits that is shared by the owners of the business. So preference shareholders would have a prior fixed right, which means when you approach an institutional investor and then offer them shares for them to invest in you, you then agree on a percentage that you are going to pay per dollar that they would have invested. So for example, you could issue 100,000 $1 preference shares with a dividend of 10%, which means every year you are going to give them 10 cents for every dollar they would have invested. So the dividend that you pay them is fixed. Then the dividend could be cumulative or non-cumulative. So what we are basically saying there is, for preference shares, so dividend for preference shares, preference shareholders have a legal right to request that you pay them dividend as per the agreement that would have made, which means regardless of whether you make profits or not, preference shareholders will always be paid what is due to them. Then ordinary shareholders have got full participation in terms of dividends, which means they get dividends as and when they are due, But the difference between the dividend paid to preference shareholders and ordinary shareholders is preference shareholders are given a specific percentage that is agreed upon prior to them buying the shares, and that percentage does not change. If they agree on a 10% preference dividend, they are going to be paid 10%. But ordinary shareholders are only paid dividends if the company makes profits. So if the company does not make any profits, it means they are not going to be entitled to any dividend. And also, the dividend paid is approved by the shareholders themselves, but at the recommendation of the board of directors. So there are some years that the company may decide that, yes, we've made profits, but we want to use the money for something else. So we are not going to pay any share of profits to our shareholders. The shareholders cannot then go to the company and demand that they are paid dividends. It's paid at the discretion of the board. So dividends can be paid in certain years and may not be paid in other years. Then in the event that the company faces some financial challenges and is winding up or liquidating, preference shareholders are given back their money first. So perhaps the business is facing challenges, we sell all of our assets, there's an amount that remains after paying all of our creditors. We'll use that money to pay preference shareholders first. And then if there's anything that remains, we then pay it to ordinary shareholders. If there's nothing that remains, then the shareholders are going to lose. So that's basically the differences between the two classes of shares, your preference shares and your ordinary shares. All right, so from now on, our consideration in terms of the issue of shares is in relation to ordinary shareholders, because we have said these are actually the owners of the business. So there are different types of share issues or different ways of a company raising money through issuing shares to its potential and existing shareholders. So the first method is a fresh issue of shares. So fresh issue of shares, we are basically saying you are issuing new shares that you have not or would not have issued before. Can you guys please mute your mics, please? Please, can you mute your mic? Okay. Right, so you said you can issue new shares. So you go to the stock exchange, you issue new shares if you're a public company, and then people buy your shares and you get money out of it. Or you issue new shares as a private company, and then people that are already owners within the business invest or buy new shares. That's fresh issue of shares. You can also get money by placement. So placement basically means instead of you going to a stock exchange and advertise your shares so that anyone who wants them can come and buy, you can approach an institutional investor and ask them to buy your shares. So for example, if you want to raise more money, you can approach Old Mutual or you can approach NASA or any other investment company and say, we are offering you these shares. Can you please buy our shares? We are going to be asking you to pay less than what you'd pay if you were going to buy from the stock exchange. So you negotiate on a sale of a lump sum of shares to an institutional investor. That's placement. Then we are going to look at rights issue and bonus issue in more detail, starting with rights issue. So rights issue, we are basically saying you want to raise more money, but you don't want to change the shareholding that is already there. So let's say, for argument's sake, you've got 5 shareholders. Each of the 5 shareholders has got 20,000 shares of $1 each, which means each of the 5 investors have invested 20,000 to make a total of 100,000 in the company. You want to raise an additional 100,000. So you can approach the shareholders and say, I am offering you the same number of shares like the ones that you already have, so that we can gain from an additional $100,000. So you are asking existing shareholders to give you more money in proportion to their existing shareholding, which means after you have issued the shares, each of the shareholders still has 1/5 shareholding in that particular company. Right? So that's a rights issue. You are giving the right of first refusal to the existing shareholders. So you want them to buy additional shares without you diluting control. So it means after issuing the shares, no one will then have more shares or more shareholding in terms of percentage than the shareholding they had before you issued the rights issue shares. Right now, if you are doing a rights issue, it means you are asking existing shareholders to give you more money, but they are paying or buying new shares in proportion to their existing shareholding. But they are still going to be asked to take it. Now, the idea behind a rights issue is we are going to people that did not express interest in buying our shares, and then we are asking them to buy shares that they did not want to buy. So let's take, for argument's sake, if someone wanted to go to buy your shares at the stock exchange today, they will be asked to pay $5 per share. Now we are approaching them and saying, can you please buy more shares in the company that you already have shares in? We can't then go and ask them to pay $5 because they would ask you, if I wanted shares, I would just go to the stock exchange and buy them at $5 myself. So it means you need to then give them an incentive to actually want to buy shares they didn't want to buy in the first place. So for argument's sake, you can then say, shares at the stock exchange are costing $5 a share. I am offering you these shares at $3 per share. So someone would then look at it from an arbitraging point of view to say, I could buy these shares at $3 and go and then sell them on the stock exchange at $5, which is the market price, and then make a profit of $2. So the idea behind the rights issue is we are asking them to buy shares, but we are asking them to buy shares at a discount to the market value so that we ask them to actually want to buy. So that we Nyasha, can you mute? Okay, so we are enticing them to want to buy new shares by offering them the shares at a discount to the market value. So that's basically a rights issue. We are asking existing shareholders to buy more shares that they would ordinarily not have wanted to buy. Right, then we are also required to know about bonus issue of shares. So bonus issue of shares is basically where we are issuing new shares to existing shareholders without asking them to pay anything for it. So that's where the bonus part comes in. We are asking them to buy new shares. We are offering them new shares or giving them new shares, and we are not asking them to pay anything for it. So the most common type of bonus issue is called a scrip issue. So this is basically where, let's say, for example, we've discussed and said, we share profits by giving dividends to shareholders. So at the end of every year, if we've made enough profits, we decide that we want to give part of the profits to the owners of the business. We do that through paying dividends. So let's say at the end of a particular year, we don't really have the money, or we might have the money, but want to use it for something else. But we still feel that we want to reward our shareholders by giving them something. So we could then give them new shares as opposed to paying them money through dividends. So we can then just pay them in proportion to the dividend they were supposed to have gotten. So for example, if someone was entitled to a dividend of 10,000, we basically just give them shares worth 10,000 and then not ask them to pay anything. So that's a bonus issue of shares. So the fact that we are issuing shares and we are not asking them to pay anything does not necessarily mean that those shares are 100% free. We are still going to be paying for them as a company from the resources we've already gotten from the shareholders themselves. But that's a discussion that we are going to do in the next module, how we finance a bonus issue. But for now, since this is just an introduction, a bonus issue is basically shares that we give to existing shareholders, and we are not asking them to pay anything for them. Right, so that's basically bonus issue and rights issue. So I'm going to just illustrate something so that you can understand it better from a question perspective. So let's say, for example, we are X company and we have got this whole following capital structure. We have 400,000 ordinary shares of 50 cents each. That resulted in you raising 200,000 in terms of share capital. Right now, I'm going to briefly talk about the concept of share premium so that you can have just a broad understanding. So what this means is, if we've got 400,000 ordinary shares of 50 cents each, it means we would ordinarily ask someone who wants one share to give us 50 cents. But there are situations where we can then ask them to give us more money. For example, if our shares are on high demand, means more people want the shares, so we may decide to then add a premium on top of the 50 cents and say, for argument's sake, the shares are going to be denominated 50 cents each, but we are asking you to pay 60 cents per share. So the share you are holding is for 50 cents, but we have paid 60 cents for each. The extra 10 cents is called a share premium. So it means we are going to then record them at par value, which is 50 cents, and then add a share premium account that we account for the extra 10 cents that we have asked the shareholders to pay. Then retained earnings, you know about this one, is just an accumulation of all the profits that we have gotten before that we have not used or utilized. So it means over the years, 230,000 of profits are still within the entity, we have not used them. So it means from an owner perspective, you would say, as owners, we invested 200,000 in terms of ordinary shares. We paid a premium with 70,000 for it, and there are profits with 200,000 that we have not yet used. So the total equity that we have in the business is 500,000. Then we are required to show the capital structure after the following. So the first one, we do a 1-for-2 bonus issue. So if you are told that we are doing a 1-for-2 bonus issue, we are saying we are giving you one share for every 2 shares that you already hold. So for every 2 shares you already hold, we are giving you 1 additional share. So since there are 400,000 shares already, it means we are issuing half of 400,000, which means we are issuing 200,000 additional shares. So this is what it would then look like. So let me just do this. All right, so it means we are issuing new shares. So the new shares we are issuing are 200,000. Okay, right. So if we're issuing 200,000 new shares, it means the number of shares that we now have are 600,000. So we now have 600,000 new shares at 50 cents each. Okay, so it means our ordinary share capital is now 300,000. The 200,000 that we had before, plus the additional 200,000 shares that we have issued that have given us 100,000. Now, if we are issuing new shares through a bonus issue, it means the money is actually coming either from the share premium or from the retained earnings. So we start by utilizing the share premium first. So we are basically saying we are giving you new shares, but you've already paid for them when you paid a premium on the shares we had already given you. So the 70,000 is money that you had already paid. That's why we are giving you new shares. It means the share premium will no longer be there. That's 70,000. But the bonus issue that we have done is worth 100,000, not 70,000. It means the share premium after being exhausted would then remain 30,000 that we need to still get from somewhere. We'll take that 30,000 from the retained earnings, which means we no longer have share premium, but we now have retained earnings. That is now 200,000 instead of 230,000. So you then realize that the total shareholders' equity is still the same, is still 500,000 because it's a bonus issue no money is actually coming in. If we are actually getting money from the shareholders, you then have realized that the total shareholders' equity would actually have changed. So because we are not receiving any money, the total shareholders' equity is going to be the same, but we are saying the share issue is not being financed by the shareholders themselves through paying us money, is going to be coming from the reserves that we already have as an entity. So that's basically how we then account for a bonus issue. All right, then from a bonus issue, we are then asked part B to do a rights issue of 1 for 3 following the bonus issue. So following the bonus issue, we now know that we have got 400,000 ordinary shares we had plus 200,000 that we issued, which means we now have 600,000 in terms of shares. So we have 600,000 shares of 50 cents each. We are now doing a 1 for 3, which means we are issuing a third of the shares that we already have. So if we are issuing a third, it means we are saying 1/3 of this, which gives us 200,000, which means the total number of shares is now 800,000. Right. So if we are doing a rights issue means they are still paying us money. But as we've discussed, we may ask them to pay us less money than what they would have paid if they had gone on their own to buy the shares from the stock exchange. So in a full question, you will then be given the rights issue price. So let's say for argument's sake, we have asked them to pay $1 per share. So if we ask them to pay $1 per share, considering that the shares per value is 50 cents, it means we would have issued those shares at a premium of 50 cents. Now, I don't want to confuse you at this stage by then referencing to the market value and then the discount that we issue shares at. But for now, what we need to understand is the number of shares is going to change as a result of us giving a rights issue of shares. And then the total shareholders' equity is also going to change because from a rights issue, we are actually going to be receiving money. So if we are going to be receiving $1 per share, it means our ordinary share capital will then be, so your ordinary share capital will be 800,000 shares at 50 cents each, which means we'll have 400,000 there. Then since we are issuing the additional 200,000 at $1 when the par value is 50 cents, it means we have charged a premium of 50 cents per share. So for the 200,000, if you are charging a premium of 50 cents, it means we are getting an additional 100,000 as share premium. We already have share premium of 70,000, which means our share premium then becomes 70 plus 100. So our share premium then changes to 170,000. And then our retained earnings is going to remain the same at 230, which means the total that we now have becomes 800,000. So as a result of the rights issue, we now have 800,000 in terms of total shareholders' equity instead of the 500,000 that we had before we did that right issue. So if you then say your total shareholders equity or your total number of shares is 800,000 at 50 cents, it means you are still accounting for them at par value. The difference between the 50 cents and the $1, you account for it through the share premium, and your retained earnings is not going to be affected. So that's basically how you then account for issue of shares when it is a bonus issue and when it is a rights issue. So that's basically how we account for the shares. All right, so let's move on to the company financial statements. I know that you have already looked at it, or you already looked at part of it in the last semester. So these are the components of the financial statements that a company would be expected to produce. So if you are a company, a private limited company, you are expected to come up with a statement of profit or loss, and other comprehensive income, you are required to come up with a statement of financial position, a statement of changes in equity, a statement of cash flows, and then the notes that support the 4 statements that we have talked about there. We have already looked at the statement of cash flows, I think in the previous session that we did. We are not going to look at the statement of changes in equity and the notes to the financial statements in this particular module, but we are then required to know how a statement of profit or loss and other comprehensive income and the statement of financial position would ordinarily look like. So you are not going to be asked to actually prepare these 2 statements in this module. So what you need is a broad understanding of what is included or involved in these statements, but the preparation part of it, you would actually then do it in the next module. So how does the statement of profit or loss and other comprehensive income look like? So the main elements of this statement is for us to account for all the income that we generated during a 1-year period. It could be a 6-month period or a quarter, it does not matter. But from a reporting perspective, we would assume that you would be required to produce this statement at the end of each financial year. So the income could be from the revenue through the sale of goods and services. It could be from other sources. For example, it could be profit on disposal of a non-current asset that you don't want to use anymore, or some service that you don't ordinarily give that resulted in you getting money in this particular financial year. So we're going to account for the income. How much income did we make? And then we're also going to account for the expenses that we incurred in generating the income that we have accounted for at the top there. So we are basically comparing the income that we make as a business against the expenses that we incur in generating that income to get the residual value. If our income is more than the expenses, and then we are going to make a profit. If the income is less than expenses, then we are going to make a loss. So this is how a statement of profit or loss and other comprehensive income look like. We first account for our revenue. How much money did we make from selling the goods and services that we usually sell on a daily basis? How much did we incur in terms of cost of sales? So basically cost of sales, we are saying if you are selling goods, how much did you actually pay to acquire the goods before selling them? So for the goods that you sold, how much had you paid to acquire them? So that's your cost of sales. So your gross profit then becomes the difference between your buy-in price and your revenue, or the amount that you then get after selling to your customers. Okay, so how much did we get from selling? How much did we paid when we ordered the goods? That gives us our gross profit. Then we add any other income that we got from other sources of income. For example, your profit on disposal of non-current assets, or any interest that you would have gotten from investments or from money that you have invested in the bank, etc. So that's other income. Then we would consider selling and distribution expenses. How much did you pay to actually deliver goods to your customers or to transport goods from one point to another? That's your selling and distribution cost. We'll then consider other administrative expenses or operating expenses, like your rentals, your salaries, your telephone, etc. How much did you pay in terms of expenses to be able to operate your business? So what you then get, if you deduct all of these costs from your revenue, is the profit before interest and tax. We account for interest separately because interest has nothing to do with the operations. It's the cost of you raising finance. So it's below the line item. We first account for profit before interest and tax before then deducting finance cost. So profit before interest and tax is sometimes called operating profit. So it could be operating profit or profit before interest and tax. We then deduct the cost of raising finance, which is your interest or finance cost, for you to get profit before tax. Then you calculate your tax that you pay to Zimra. You deduct it, you get profit for the year, or what you would ordinarily call net profit. Then we go to other comprehensive income. Other comprehensive income is other income that is not necessarily realizable. For example, we can decide to revalue our assets. I know you have not covered IAS 16 in detail, but basically we are saying if you've got a building that you bought for 100,000, but you feel that if you're going to sell it today, you would actually fetch 120,000. It means your asset would have gained in value by 20,000. that 20,000 is unrealized because it's not money that you are actually holding, but we are going to recognize it as an other comprehensive income item. So if you add it to profit for the year, you then get your total comprehensive income for the year. So this is how your statement of profit or loss, the other comprehensive income would look like. The actual statement, when you present it, would be retrospective, which means if you are preparing for 2022, would also expect to see a column for 2021, so that would then be able to compare your performance last year and your performance this year. All right, then the statement of financial position, I'm sure you have also covered this under your sole trade accounts. We start with your non-current assets. So your property, plant and equipment is your motor vehicles, your buildings, your office equipment, etc. That's property, plant and equipment. Then any intangible assets, if you've got any investments, if you've got any goodwill, any assets that do not have a physical value or a physical substance would be under intangible assets. Then you account for your current assets, those assets that you expect to give you value within a period of 1 year. So for example, if you've got the stock that you expect to sell within a period of 1 year, you account for it there. If you've got the receivables, people that you sold goods or services to on credit that are yet to pay you are current assets, because you're expecting that they will pay you within a period of 1 year. If you've got any cash at the bank or cash at your premises, you also account for it as a current asset there. So the total of the non-current assets and the current assets then gives you the total assets that the company has. Then you go to your equity. So your equity is basically the section that accounts for the share capital that we're talking about, what you actually have invested in the business as the shareholders. So it will have your share capital. So the share capital here is the ordinary share capital. We don't put preference share capital there unless it is irredeemable. But for our intents and purposes, share capital is ordinary share capital, and then that's it. Then share premium, if we had issued those shares at a premium, we are going to also then put the share premium there. Revaluation surplus, you do remember that we talked about it here when we said gain on property revaluations. If you revalue our asset, in our example, the asset is worth 120 if you sell it today, but we bought it for 100,000, there's an extra 20,000. So as long as you then put it here, you need to create a reserve. So you are then going to put revaluation surplus for the same 20,000 under equity. So we are basically saying, as owners of the business, we have got assets that are worth more. So the 20,000 actually belongs to us. Then retained earnings, we've already talked about it. It's an accumulation of profits that we have not yet utilized. Then we go to non-current liabilities. So these are obligations for you to pay, but you're going to be paying them over a period of more than 1 year. So if you've got loans that are 1 year loans, they go under current liabilities. But if they are loans that you pay over a period of more than 1 year, they then become non-current liabilities. Then redeemable preference shares. So for now, we are not going to concern ourselves about this, but basically we said preference shares are people that give us money, but they are not decision makers within the organization. So they are as good as people that have given us a loan. Redeemable means at some point in time, we need to give them back their money. So if you are going to be giving them back their money at some point in time, it's as good as Chikweret. So we put it under non-current liabilities. If we are not going to then be expected to pay them back their money, but we continue to pay them their dividends, it would then qualify as part of equity. Then your current liabilities are the obligations to pay within a period of 1 year. So if you've got any people that sold you goods or services on credit that you need to pay back, they will then fall under current liabilities. If you have got tax obligations that you have not yet paid to the tax authorities, it also then becomes your current liabilities. So if you then add total equity and total liabilities, you then get total equity and liabilities. And as you know already, your total assets value should always be the same as your total equity and liabilities. In other words, your sources of finance here is equity. The owners of the business have given you money, that's equity. You have also borrowed some money from the banks. If you add the total that the owners of the business gave you and all the borrowings that we have, that would then translate to the money that you have still that you haven't used, that is cash, and the money that you've used to buy those assets that we are talking about. That's why we expect that the sources side of it and the application side of it should always be the same. So that's basically how your statement of financial position would look like. So those are the two statements that I expected to know. And like I said, you are not going to be required to actually prepare these statements in this module. You are required to basically understand how they look like. And then it's important for you to know what they look like so that you could then be able to interpret them. If someone gives you a statement of profit and loss and statement of financial position for two companies or for 2 different years, you should be able to make sense out of it. So what does it mean if our property, plant and equipment has increased? What does it mean if our share capital has decreased, etc.? So that's basically the interpretation of the financial statements that we are going to be looking at next. Right, so that concludes this session, the introduction to company accounting. So we are going to then use the time that remains to look at the interpretation of financial statements. How do we then interpret the statement of profit and loss in the statement of financial position if you are given those statements? So this is examinable in your module. So I will stop this session. Then can you please rejoin just like what you did so that we can start another session and record it as a separate video. So I'm going to stop this session. Can you please rejoin again using the same link that you used to join for these 2 sessions?